Hey guys, welcome back to the channel. In today's video, I'm going to be showing you a very effective strategy that works well on most trading instruments, particularly on the shorter time frames, and it's the first pullback trading strategy. So whether you're trading stocks, Forex, commodities, or even cryptos, this method will help you identify opportunities to really jump into the trend very early. If you're a beginner, don't stress. I'm going to take you through the strategy step by step so you can see not just what I'm doing, but why I'm doing it too. Remember that trading is risky and most people lose money. This video is for educational purposes only and it shouldn't be taken as investment advice. All charts are historical and I always advise that you test out any strategy for yourself on a demo account before you try it in the live environment. Hey guys, I'm Ali from FX Scouts. So in this video, I'm going to be showing you a popular trend following trading strategy, and I'm going to be showing you how to apply the rules, and then I'm going to show you a winning trade and a losing trade too. Before we get started, I just want to show you the basics, and with that I want to show you what a pullback is and why you should care about pullbacks. So a pullback happens when the price moves in the opposite direction of the trend. It's like a temporary pause before the price continues in its main direction. Many traders ask, why don't you just jump into the trade? Jump in when the trend is driving up rather than waiting for the pullback. And this is a great question. So the reason we wait is because we're waiting for momentum. And during that first big move, the price may be overextended or it heads into overextended territory. If you jump in too early, it can be risky because the price might retrace and then hit your stop loss, meaning that it temporarily moves against you. By waiting for that pullback, we let the price settle and we get a better entry. And you ensure that the price will move in the same direction. So how do we know where to enter? Well, this is where the 20-period moving average comes into play. And a moving average is basically a line on the chart that shows the average price over the last whatever periods, in this case, the last 20 periods. And in an uptrend, the price often pulls back and touches this line before continuing higher. And what many traders find is that it's a very reliable way to see if the pullback is still part of the trend or basically if something has changed. So for this strategy, you'll wait for the first pullback, but you'll wait for the price to hit your 20-period moving average before you enter the trade. So now here's the basic strategy. The entry point is where the price first touches the 20-period moving average during the first pullback. When it comes to the stop loss, to manage your risk, we use a very simple method. So we measure the range of the initial drive from the highest to the lowest point of the move. And then you'll take half of that range and use it to set the stop loss below, if it's a long trade, or above in a short trade. This way you have a very clear predefined point that you'll exit if the trade doesn't meet your expectations. For the target, we aim for a 2-to-1 risk-reward ratio. So this means that if you're risking 50 pips based on your stop loss, you'd aim to profit at 100 pips. And this approach basically helps to ensure that even if not all your trades are winners, you'll still come out as profitable over the long term. Now I want to show you a real-world example. Okay, so this is the DAX, which is a popular stock index in Europe. Now, the market opens at 8 a.m. UK time, and you see a strong upward drive, a clear signal that momentum is behind this move. And I like the DAX because you'll often see this at the open of the session with the DAX. Now, instead of jumping in right away, we wait for the price to pull back and touch the 20 EMA, which it does over here. Now we look at setting our entry. So we measure the range, and the stop loss is based on 50% of the initial move's range. And then of course, you're going to set your target at twice the risk. So as the trend continues upwards, we hit our targets and we lock in those profits. Now you've got to be aware that not every trade is going to work out that way. And as I said, I'm going to show you a losing trade too. So here's another example. So you see the initial drive up, you then see the pullback, and we measure the range and enter on the next candle. You set your stop at half the range below that entry when we've measured the range here. And then you set your target at twice the risk. But as we see, the price does not continue up and your stop loss is triggered. What's important is that our risk was controlled and that the potential reward was twice that of our risk. Now, I find this an effective strategy, but again, it's not going to work out like this even if you follow these rules all the time. But what will make you profitable over the long term is if you keep that risk reward ratio in check. So if you have a risk that's half the amount of your reward, then over the long term, of course, you are going to be profitable. And just in closing, a lot of traders ask why we focus on the first pullback. Well, as I mentioned earlier, the first pullback seems to have the most momentum behind it. Traders are excited and institutional players may be positioning themselves and the trend is fresh. Later pullbacks can still work, but they often occur as the trend is weakening. By focusing on that first pullback, you tend to catch the strongest part of that trend while also limiting your losses. And this is why I like to focus on the opening trades of the day. Thank you so much for watching. If you enjoyed this video, please remember to like and subscribe, hit the notification bell, and we'll see you in the next video.